You're listening to OPIS Talks, where you'll be in on conversations with insiders in the energy, chemicals, and environmental commodities markets. Guests share insights into the latest trends and innovations, industry challenges, and much more. Let's dive into the conversations that explore where the energy economy is headed, right here on OPIS Talks.
Hey everybody, I'm James Stevenson and welcome to our latest Tariff Talk discussion. I run the research group in coal, metals and mining here at Dow Jones Energy. Joining me today as usual is Charles Dayton. How's it going, Charles?
Hey, James, doing well, thanks.
And for those who either don't get to read these or maybe aren't aware, Charles is the lead writer on our Tariff Talk publication. And despite the name, we touch on many topics, certainly not just tariffs, although we did have a little return to tariff discussion a month or so ago. But I think we've had a lot on geopolitics and movements in the global macroeconomy that have an impact on the commodities that we cover. And those are primarily the ones used to make either electricity or to make steel. And so obviously been a big impact from what's been going on in the Middle East. And I think at the end of the last couple of these recordings, we, pondered if we'd still be talking about this in a month. And yet again, we are. So yeah, let's start with the Middle East, Charles. I think one of the great things about our Tariff Talk publication is it gives us a chance to highlight risks. So we, of course, talk a lot about our base case expectations and at Dow Jones Energy, we have a base case expectation that the current kind of ceasefire, this MOU and so forth, it does cause a conclusion to conflict, kind of in the relative near term. And then I think we have about an 18-week recovery period as flows move back to a new normal. However, there are downside risks to that base case, and Tariff Talk does let us talk about those a bit. It certainly doesn't seem, Charles, that the market is pricing much of this downside risk. So we have crude oil prices sitting around $70 and the Dow at kind of records or near records. Do you think these downside risks are being adequately priced, and do you think they're being adequately managed?
I guess the answer to your question, James, would be by whom? In terms of actual benchmark oil prices, you're right. We're back to basically where we were before the war even started. We lost, 1.3 billion barrels of oil, and the market is basically shrugging that off and saying that doesn't matter. It's, flow versus inventory, and the flow is going back to normal. So who cares? The inventory will return eventually. And, it may be true. We'll see. But yeah, we lost over $1 billion of global oil. We still have, at best, we're getting close to pre-war averages on our best days when we're coming out there. The U.S. administration saying that we're seeing, record oil through the Strait at 18 million barrels. And before the war, the average is 20 a day. We're probably averaging less than half of that right now, even with dark transits and everything else. But yeah, the oil prices on Brent and WTI both say, hey, this is done. The place where I would encourage our clients to look, though, is in those crack spreads. We're blowing out to record levels. If you actually extrapolate, where crack spreads are, and just 3-2-1 crack spread is the one we kind of like to use the most. If you compare that historically, where oil prices should be given where crack spreads are, we should be seeing oil prices 110, 120, somewhere in there, and we're not. And so there's a disconnect between the actual product market and the oil market. You can have a lot of arguments about, is the oil market just out in front and eventually the refiners will catch up? There are national security reasons you don't want the Iranians to think that their embargoes are actually working in the Strait and that the market should be at record highs and that oil should be back to normal, because that kind of deflates the whole argument that Iran can do something here. But the simple fact is you're not seeing almost anything come out anymore. The southern of the two routes through the Strait of Hormuz, the so-called Oman route, which is the one the U.S. prefers, you're not seeing a whole lot go through there without a massive U.S. military escort of what's going through there. Not only that, we saw many tankers turn around this weekend. We're not sure why. Rumor is IRGC speedboats got them to turn around. But, long story short, most of what's going through the Iranian route is Iranian oil. Most of that, about 3/4 of it, is headed to China. And through the southern route, they're not getting through without a massive escort, and even then it's dicey. So given all of that, and that Hormuz still remains about 20% of the oil moving around the world, it does seem kind of odd that you would see oil prices as low as they are, unless, again, as I said, some kind of a state actor is kind of putting their thumb on the scale to keep oil prices lower, which again, national security reasons, there's a good reason to do it. But I think to just kind of say, oh, the market is ignoring everything, we're back to normal, I think there is something behind prices being as low as they are.
You sort of talk about flows out of the strait, and one of the things I think that is pretty widely discussed is, can that crude oil products, LNG, get out other ways? Now, the UAE obviously can get some out of Fujairah. Currently, the Saudis can pipe some south out to the Red Sea, but when you talk about the Red Sea, the assumption there is that you can easily transit the Bab el-Mandeb Strait. You wrote about the Bab el-Mandeb Strait, and that's the one basically between the southern tip of Arabia and the far east of Africa. You wrote about this a few weeks ago as a potential risk returning, and just over the weekend we've had some conflict between the Houthis, and I think in the regular press there's talk about a vessel having been attacked. Talk about your thoughts around the Bab el-Mandeb Strait, and if the Red Sea truly can be an outlet for Middle Eastern product.
Kind of like we said, we wrote about this because our concern was the next place you're going to see issues is down there in the Bab el-Mandeb Strait with the Red Sea. Just a quick history lesson for everyone. Back in about 2023, in response to the Israeli war in Gaza, the Houthi rebels there, who control most of Yemen now, they closed the Bab el-Mandeb Strait. And just so everyone is clear, the Houthis are on a whole different level than the Iranians and not a better one. Houthi military, you're talking about 20,000 people, not a whole lot of sophisticated anything. And when that happened, the US rounded up a coalition led by the UK with several other Western European countries mostly. And they did a heavy bombing campaign against the Houthis. We sent several carrier groups there to try and kind of force back open the strait. And the end result of all of it was we had a ceasefire that was put into place under Trump finally here in 2025, and traffic never recovered. It still hasn't to this day. So 20,000 people with less sophisticated arms were able to shut down that strait, survive a coalition onslaught, not just one or two countries. And the traffic never really returned, even with what is going on right now in Hormuz and everything else. So why does that matter? Because to your point, James, the Red Sea has two outlets. You have the Suez Canal on one side and you have the actual strait on the other. Why can't people use the Suez? And they can. The problem is the composition of actual tankers we have in that whole Middle Eastern, Persian Gulf, Red Sea area. Roughly 3/4 of it are these VLCCs, or very large crude carriers, and this is by volume. And those cannot fit through the Suez Canal. So you have, the Suez Maxes and lower is what you've got going through the canal, and they're already mostly tapped out full going through as it is. Most of that goes to Europe, smaller routes, very little of that to Asia. So you have the Houthis who managed to shut it down before and keep it shut relatively without a whole lot of issue, despite being a much smaller army. Again, I believe I said 80,000 man army they have. The Iranians have 1 million. So it just shows you kind of the relative size of the two of these. And the Houthis control a territory roughly the size of Iceland, while the Iranians control a territory for you Americans, everything east of the Mississippi of the US. So, again, it's kind of a night and day difference. But yeah, we heard this weekend that the Houthis fired at a container vessel. We also heard that there were airstrikes on the Houthis and several of their military encampments and cities. We don't know who was behind that right now. We're trying to figure that out. The market's trying to figure it out. But, it remains an issue that when you do, as you said, James, use the East-West pipeline to move a whole lot of oil down to the Red Sea out of Saudi instead of moving it through the Persian Gulf and through the Strait, then the Red Sea and the Bab el-Mandeb Strait becomes more important. And that's where I think we are now, that I think Iran is not happy that the US is trying to open up their own corridor and kind of has through Hormuz. They're not going to be happy if the volumes increase. You'll see two pressure points for that. You can see an attack on one tanker in the strait can disrupt things for a couple of days, as we've seen before. But again, you're seeing a bigger issue now with Bab el-Mandeb itself, that they can have their Houthi allies go ahead and shut that down as well. And then you run into issues of, we were not really able to force it open back in the day. If you remember, we lost a couple of aircraft during evasive maneuvers. They fell off the decks of carriers and things like that. It didn't sound like it went all that well. So this is not just a Strait of Hormuz issue. This remains, how do you get oil out of the Middle Eastern oil producers at all? There aren't a whole lot of pipelines at all, except using one of these two routes. And if one of the routes, Iran starts to worry that it's losing its grip, we fully well think that they can double down on the Bab el-Mandeb, and they probably will here.
This is obviously a hugely topical thing particularly for our clients in Asia. You referenced the crack spreads earlier. We still have high diesel prices around the world, and I think there's a little bit more discounting of the risk of a diesel shortage. We're not really out of the woods until we're out of the woods on this, but certainly some of our clients in Asia and other companies that we talk to and so on are dealing with, what do we do if we don't get as much LNG as we had planned on getting? What do we do if we don't get as much diesel as we'd planned on getting? So these conversations are certainly happening, and one of those, of course, is what do we do, over the next kind of 5 to 10 year period. And our general view remains that this is net of net bullish coal demand, as LNG kind of pushes some of that demand away towards coal. Ironically, it's positive for things like biodiesel and stuff, which are a hedge, albeit still quite an expensive one. But I think we will get, more things like electrification of trucks and so forth, because entities around the world are, going to be looking for a bit of a plan B, or at least a hedge against additional stuff like this happening in the Middle East. Let's move on from the Gulf. Charles, the yen, the Japanese yen, hit a 40-year low about a bit over a week ago. It made headlines, and obviously, there are concerns around the Japanese economy and so forth. First of all, talk us through what happened, what's going on. But secondly, given that Japan is a country that imports an awful lot of stuff and then turns it into other things and exports it, how big a driver is a weak yen, and how problematic is it?
So in our view, in my view, this all kind of started when Takaichi was elected the prime minister in Japan. When that came out, and I encourage our clients to go back and read our article, we basically said, hey, the Nikkei is going to do quite well on this news, and the yen's going to do quite bad, because the plan was basically to run things hot and to grow the economy, and that's how you would solve all kinds of issues, including debt issues. Now, when that happened, the Bank of Japan very vociferously came out and said, hey, we're not letting the yen depreciate down more than 160 yen to the dollar. And they've held that pretty well. If you go back and look at the chart, you can kind of see us bumping up against that 160 level quite a bit, but not really breaking through it until 2 or 3 weeks ago, maybe. And there are a couple of reasons: A, why they're defending it so strenuously, and B, why we finally broke through it. So let's go to first why they're defending it. So we have, as you said, I get this a lot from clients, is we don't care about the yen for Japan because Japan will import things, prices will go up if the yen weakens, but they'll get it back on the export side. And while that's true, I think people kind of oversell how little Japan's economy really is export driven. So the most recent trade data I have was Japan has a $4.38 trillion GDP with exports about 740 billion. So you do the math, that's about 16% of GDP is exports versus 10 or 11% in the US. So Japan exports more as a percent of GDP, but it's not entire galaxies away. This is more, two nearby planets type of thing. So that's part of it, that a whole lot of this is the Japanese economy, which is the fourth largest economy in the world, one of the biggest importers in our space of LNG and coal and oil and, both thermal and met coal, that they're not just some kind of a, transit to make something better quality or a different quality and export it, but that a whole lot of that remains domestic consumption too. Now, that's not the only issue here, though. As we probably all know at this point, Japan has, in terms of debt to GDP, they have the highest debt of any major country in the world. It's well over 200% at this point. And it's been asked for a while now, kind of how is that sustainable? And we've written on it. Again, I would suggest our clients take a look at it. But a big part of that is the carry trade, where you have Japanese yen denominated bonds that yield very low. You can borrow very low as a result, and you can turn around and invest in something that gives you higher returns somewhere else. And that's kind of a carry trade. And that's been working for quite a while here now, right? It's a big part of what has driven a whole lot of cheap debt around the world. As it came into COVID in 2020, the Japanese 10-year was yielding negative. So you could get paid to borrow in Japanese bonds and go ahead and convert that to something else and do something else with it. Now, that only works with two different caveats. One, you need the yen to be relatively stable because you carry a whole lot of currency risk you have to hedge, and hedging gets more expensive if the yen is not stable. Japanese ministers know that. They know that they have to keep the yen fairly stable, or people will move out of the carry trade into something else and they'll invest that way, especially when your yields are as low as they are. Now, the other side of that is those yields have to stay low. And, we were just talking about the 10-year, that it was negative going into COVID. I'm looking at it today, we're at 2.839%. That would put us back to 1996 levels. So, again, the yen is yielding much, much, much higher than it has in quite a while. So if you're looking at, do I invest in a country that has 250% debt to GDP? One of the big questions is, do I think their currency will be stable? And the currency is stable given all of the extra spending, given all of the other inflationary things going on, inflation hitting highs not seen in 30 years and all of that. Will the currency remain stable? The big answer is it's a confidence game. And do you believe the Bank of Japan will defend it? And as we've seen, as we hit this 160, the rhetoric out of Japan has gotten more and more bellicose, for lack of a better word, honestly, James. I kind of think we need to use that one. But they tried jawboning, tried talking down the yen and supporting it. Their other option, though, is not one that the U.S. would really like very much. During the 80s and 90s, Japan knew they were an export-driven economy, so they knew they had to develop basically a war chest of foreign exchanges. And they did it with the US dollar. Japan is the largest foreign treasury holder in the world. It's not really close. Japan holds over $1.2 trillion in US bonds. I think the UK is second at under $1 trillion. So again, it's not even close. And Japan would have to sell that. They sell bonds, they buy yen, and then supply and demand, right? That increases the strength of the yen, so decreases the amount of yen per dollar. And that's what they've kind of been doing in fits and starts. It looks like it's becoming more and more important that they have to do bigger buys, they have to do more explosive buys, they have to jawbone more. And this morning we're still at 162 yen to a dollar, so we haven't gotten back to 160. So as this continues to develop, it's not just a problem of Japan having to pay more in their own currency to buy things. Japanese debt drives the entire global debt market, really, if you look at it in kind of a more granular focus. And if you have an issue where you don't think the yen will be defended, then that trade breaks down. The confidence in owning Japanese debt breaks down. When you're at debt to GDP of over 200%, that's a bad day for you as a Japanese policymaker. But on the other side, for Japan to defend this, it means selling US Treasury debt, and a lot of it. And again, the US is issuing record amounts of debt. We're up to almost 40 trillion. We'll hit it this year. And what are our 10 years yielding right now? 4.5%. We're much higher than we were when Trump took over, when they started cutting rates under Biden. So we're paying a whole lot more in our interest as well. So we don't want to see those yields rise, but they're going to rise anyway if Japan continues to have to forcefully intervene here. So the BOJ is kind of stuck. They're either going to have to sell a whole lot of debt and upset their American counterparts, or they're going to have to just let kind of the yen free fall, which again can blow up the carry trade. People don't want to invest in yen denominated debt anymore. It's kind of a much tougher situation than just, oh, imports are getting more expensive for Japan, if that long-winded answer makes sense.
A bit of a catch-22, it seems. Benefits but costs in both directions. Look, along similar lines, obviously discussion in the US about rate increases. You put out a piece recently on the 2-year note. I love the quote you had at the start of this one, which was saying, I forget, it was a head of a hedge fund or a private equity place saying, I'd say, because we just have a new Fed chair, but this guy was saying, I'd say put the 2-year Treasury in charge of the Fed funds rate, because that's what always is going to happen anyway. It's an interesting point. The 2 year does drive the Fed funds rate. But can you talk us through what your points were about the 2 year?
Yeah, and that hedge fund guy was Jeff Gundlach, which is a pretty
Yes.
well-known hedge fund character that likes to talk about macro, which of course we love talking about as well. But yeah, I think the thinking from most people, clients, everyone I talk to, and remember, James, in the commodity business, a lot of us are pretty heavily leveraged in debt. We have to, it's a capital intensive business, right? So the thinking from a lot of these people is, well, look, right now debt is expensive, because the Fed has had rates quite high and the Fed fund rates, now that LIBOR is mostly gone, and we're using SOFR, SOFR instead, means that a lot of commercial paper and other debt instruments are more or less heavily linked to the Fed funds rate, if not directly connected to it. So the thinking was, yeah, debts are high right now, debt costs are high, but it's going to come down because Trump wants them lower. Trump's picked Kevin Warsh. He's going to see debts lower and it's all going to be okay. And I keep having to kind of tell people, the market's really not saying that because yes, we're all hearing that. But, I would say we talked before about how the 10-year went up since the Fed started cutting rates in September of 24 under Biden. So, the question I would pose to you or anyone else is, okay, yeah, the 10-year went up, but, again, the 2-year is what drives everything related to where the market says the Fed should be going in terms of Fed funds rate. With all of this scuttlebutt, with Trump coming in and pushing rates down, what is the 2-year saying? And I think anyone without looking at the data would say, well, I'm sure it's lower than it was in September of 2024, right? And it's not. In September of 2024, we were sitting at a 2-year yield of about 3.5%, a little over. We've come off a little bit in the last few weeks here because of all that we've talked about oil and expectations that inflation won't be quite as high. We're still at 4.13% right now. So the 2-year, which is supposed to be where the Fed funds rate is going, is up 0.6% since we started cutting rates. We cut rates 5 times since then. So the market's saying, wait, you're getting way ahead of yourself with all these rate cuts. Rates are actually going higher. And when you look at, the CME FedWatch tool, which is a good tool to look at how traders are pricing what the Fed will do in terms of rates, if you look at the end of the year, the chance of a rate cut is exactly 0%. There's a higher chance that rates will increase back those 4 of those 5 cuts we saw by the end of the year, then we'll see a rate cut. So the market is pricing rates are going back up, and they may be going back up by a lot. I'm not sure we're there yet. We've written a couple articles on CPI and inflation, which again, I encourage our readers to look at, where we say you won't see consumer inflation if consumers can't afford it. And there are a lot of reasons to think consumers are having trouble affording things, record debt levels, record margin levels on stocks, record rates they're paying on credit cards that are still at record levels. Real wages are below inflation right now. There are a whole lot of reasons why the consumer may not be able to absorb the cost, but if they do, the market is screaming we're going to see the Fed increase rates before they cut them, which I think would catch a lot of people off guard. And again, a lot of our clients who rely on commercial paper, short-term borrowing, things like that, borrowing may get more expensive here, James, going forward, and not cheaper as pretty much everyone thinks is going to happen with Trump's hand-picked new Fed pick and expectations of lower rates. I would, finish this answer, James, by pointing out Jerome Powell was Trump's hand-picked Fed pick as well. Jerome Powell ran one of the most dovish Feds possible when he cut rates and kept them low for, in our view, too long, claiming inflation was transitory. And we still ended up seeing significant rate increases. And I think ultimately, with all of these things we've talked about, how basically you need to continue to draw in buyers interested in buying U.S. debt, you're going to see debt yields continue to remain elevated, barring some kind of financial crisis type of situation. And you're going to see the Fed have to raise rates because the Fed needs to, at the end of the day, defend the dollar, and they need to defend the counterparty appetite to buy debt. Because again, we talked about Japan. We're at a roughly 120% debt to GDP. Our deficits are way higher than Japan's. We're running, close to World War II deficits. We're running severe recession deficits of 6 to 7%. That's all a confidence game as well. We need to keep global buyers buying our debt. If we're not serious about inflation, we wrote an article on this too in the 70s when the Fed kind of was no longer serious about inflation, and we had to bring in Volcker and jack up rates to nearly 30% to fight inflation. If anyone in the early 80s remembers that, we can't afford to do that again. So we really need to make sure we're showing our inflation bona fides right now, and we're keeping inflation from being an issue. And the most likely solution right now, whether you agree with it or not, the market is saying, hey, get ready for higher rates, get ready, therefore, for our clients for higher borrowing costs.
That seems to be the big downside risk. I think we've covered the topics we were going to go through on this episode. Let's just close out with what you're looking at now, Charles.
Yeah, so we've got a couple of things we're kind of looking at. One, you and I were talking about, we want to do another deep dive into China. China's managed to kind of pop their, residential housing bubble without destroying the economy. It continues to grow, and housing prices are back down inflation adjusted 2006 levels. That's pretty impressive. Look at what's going on behind the scenes with China. A big part of the reason we have not seen $200 oil is because China basically completely pulled back from oil imports. Is that a structural shift, or is that more of a temporary thing? Why is China doing that? And kind of, are they going to come back in the market now that oil's back where it was before all of this happened? To the US side, we've seen some really interesting things too in kind of the labor force and unemployment. We've written about this before, but just to give you an idea, James, of an example, last month, when the employment data came out last week for last month, we saw the unemployment rate drop from 4.3 to 4.2%. Now, historically, 4.2% is amazing. It's an incredibly low rate, and it's great. But at the same time, the 1 month change in labor force participation for that prime age group, so 25 to 54-year-olds, dropped by its largest amount since about 1968. And the reason 1968 was more is because we had a draft going on here in the US for the Vietnam War, where it took 0.5% of American males out of the total labor force because they had to go fight in Vietnam. So it would probably be further back even than that. And so the question is, why is that happening when we're at 4.2% unemployment? Labor force participation is now, meaning people that are actually actively looking for jobs, is now back down to levels in 1976 as women started to enter the labor force. Some kind of a disconnect is happening where the number of people actually in the labor force is dropping like a stone, despite all of the, to your point, stocks hitting new record highs, all the prognostications of a massive boom in the economy. And the question is why? Is it because AI is taking over the world and driving mostly men out of the labor force? Is it because a lot of the older end of the labor force is retiring early because their stocks have done so well in their retirements? It's probably a lot of different reasons. But again, we're talking to an audience where the vast majority of their workers are males. And when you look at labor force actual jobs added, over 90% have been going to women since in Trump's 2 terms. It's an interesting problem that we need to look at. So we're going to take a really deep dive on that labor force component too, and kind of figure out what's going on there as well.
Important implications for the mining sector, of course. Listen, I think that's a great time to wrap up. Look, Charles, appreciate your comments as ever. We will be back here in about a month for the next episode, and appreciate all of you listening. Thanks heaps, Charles.
Thank you, James.
We hope you've enjoyed today's insider conversation on OPIS Talks. Join us next time for a deep dive into another industry insider's world. You can find more OPIS Talks episodes at opisnet.com/podcasts or wherever you listen to your favorite podcasts.